commodities, tariffs, Fed interest rates. All of these are on the docket today as world-renowned speculator RIckRule chimes in. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. RIckRule joins us today. Rick is the founder of Battle Bank, as well as the former CEO of Sprott US and president of Rule Investment Media. And we're delighted to have Rick join us once again today. It's time to saddle up and silver up for RIckRule. Rick, welcome back to SBTV. How are you doing?
I'm doing well, Patrick. The better for being on with you. Thank you for the opportunity to visit with your audience again.
Glad to have you back, Rick. Really do appreciate you giving us your time. I'd like to start off with the persistent gradual climb and new all-time highs with the price of gold. Interestingly, because for a couple years now, we have seen a steady rise in the gold price with no real hard or lasting pullbacks. Do you attribute this constant rise on the gold price to, let's say, central bank buying, or is there something else happening with market participants that you're seeing?
I think the central bank buying is a function of the deteriorating strength of the US dollar. I think the immediate cause of the gold price increase is central bank buying, but I think it's important to understand why central banks are buying in favor of instruments that they had preferred over 40 years to gold. And that is, first of all, the weaponization of the US dollar, the realization by foreign central banks that the United States dollar isn't a neutral medium of exchange. The United States has politicized the dollar, which has in some senses forced foreign central banks to buy a medium of exchange that is also a better store of value. And the store of value is also, I think, problematic. When foreign central banks and large family offices, as an example, look at the encumbrances of the US society, the $36 trillion in on-balance sheet debt and the $100 trillion in net present value of unfunded promises, Medicare, Medicaid, Social Security, and the foreign central banks juxtapose the yield on the US 10-year Treasury with the deteriorating purchasing power of the US dollar. In addition to the dollar being risky because of politics, it's also risky because of economics. So for those two reasons, we've seen really since 2022 concerted central bank buying of gold and disintermediation out of the US Treasury, which has led to, I would argue, higher nominal, all-time high nominal gold prices. If you adjust the $3,000 gold price for the deteriorating purchasing power of the dollar, it's arguable that we aren't at all-time highs. It's arguable that we have further, perhaps substantially further, to rise.
I completely agree with that. You mentioned like the family offices. I'm just curious to know from where you sit and what you see. Are you seeing perhaps more family offices being open to physical gold, physical silver, precious metals, perhaps?
I informally advise 4 US and 2 non-US family offices. And traditionally, those family offices were attracted to me because of my knowledge of oil and gas, or perhaps mining. And traditionally, those family offices, in terms of their predominant investing activity, has been global real estate. All 6 family offices, when I talk to them, talk to me about gold now. It's very interesting. Now, in fairness, I've been talking to them about gold for a decade. And in each case, I managed to get these family offices to put in place a physical allocation, or at least a proxy physical allocation, like the Sprott Physical Gold Trust. But in every case now, the circumstances that led to our discussions a decade ago, or sometimes 2 decades ago, have manifest themselves in very concerted family interest in gold. And I'm fairly certain, given the opportunities that I'm offered to speak at family office conferences around the world, that the 6 family offices that I advise aren't unique in this regard.
Yeah, typically, they're looking for returns on investments, I suppose, such as real estate, and gold is more like a store of wealth, store of value. So I was just curious to know, how they, what kind of
That is
assets.
exactly right. Exactly right. I wouldn't want to ascribe the same motivation to all 6 offices. But in every case, I think their belief is similar to mine in the sense that we've passed through 40 very benign years in investing history, the period 1982 to 2022. Declining real interest rates, US dollar hegemony, increasing global trade, better demographics on a global basis. And I'm not trying to say the world's going to come to an end, but the next 10 years are going to be more challenging than the last 40. The consequence of that is that many, many investors from foreign central banks through offices all the way to Ma's and Pa's have decided that having part of their wealth in an insurance asset, gold, maintaining purchasing power is an important thing to do. The world, I think, is becoming more defensive. And I would argue that for at least 1,000 years, the most defensive investment available to humankind has been gold.
Yeah, we do understand central banks they're holding more gold in reserves. Uh, but being held in reserves is different from actually being out there and circulated as a type of money, let's say, or unit of account. Do you think gold will somehow get out of just that reserve position and into a monetary role somehow, some way?
I absolutely do. I believe that within 2 years, perhaps 5, but within 2 years, that there will be one or more broadly utilized gold tokens, gold trading on the distributed ledger. That, well, when I say gold, a deposit receipt, redeemable, you know, and fully backed by gold. The World Gold Council is trying to affect this. The London bullion market is trying to affect this. I've made some investments. Sprott has made some investments. There are a variety of technologies around, first of all, uh, establishing a deposit receipt that is recorded, entered, and transferred on the blockchain, and then tokenizing that. And I would expect that within 2, but certainly within 5, you will be able to have either a credit or a debit card in your wallet that allows you to save in gold, receive interest in gold, and transact in gold. This will likely be a private currency, like blockchain is, not a government sanctioned money. But I think it's all a good thing. I think the establishment of the psychological infrastructure around blockchain implemented transactions has allowed for gold to return to its former role. You can, in many countries, and I have, used gold as a medium of exchange. But the transaction costs are very, very, very high, among other reasons, because people need to assay the gold that they receive or pay. If you had London bullion market and World Gold Council certified storage facility where you knew that the gold in place was good delivery, good system delivery, and you knew that the token was fully backed by gold, um, you could lower your transaction costs substantially, just the same way that the hard transaction costs around cryptocurrencies are very, very low. You know, uh, I think that's just a really, really, really important development. And I think we're 2 to 5 years away from that. There will always be, and there is a place for holders of physical gold and silver to have it outside of the blockchain, outside of the system. Because understand that the system is the system. This will be part of the global financial system. It will be within reach of governments. It will be within reach of institutional failure. So I'm not trying to suggest that blockchain denominated delivery receipts will replace physical private ownership for gold or silver. I am merely suggesting that in addition to gold fulfilling that role, and in addition to gold fulfilling a role for central banks, that it will, in answer to your question, once again become a medium of exchange rather than merely a store of value.
I want to move on to just a few other commodities. One of them being nickel. I've been seeing and understanding. There's a sort of a silent race going on regarding EVOTLs, or these one person type of flying electric vehicles. The batteries for these personal flying craft and even for the electric vehicle car, they're known to use nickel. In fact, there's more nickel as opposed to lithium in these batteries. So with that, I'm curious to know what are your thoughts on nickel?
I'm attracted to the nickel market, particularly because so many people hate it. There has been a real supply surge in nickel, largely from Indonesia, but also from the Philippines. And this is nickel that is produced from lateritic surface ores. And you're in the part of the world where that's happening. The environmental devastation that's taking place, particularly in Indonesia, particularly in southern Sulawesi, is mind-boggling. I flew over this some months ago. And my suspicion is that the growth in lateritic nickel production, and particularly low-cost lateritic nickel production, will begin to decline as neither the Indonesian citizenry nor the Indonesian government, I think, will be willing for much longer to tolerate the environmental destruction that's happening as a consequence of this lateritic nickel production. If that happens, I think it's when, not if, but if it happens, the cost of producing lateritic nickels goes up immediately. And I suspect makes the traditional sulfide nickel much more economic. In addition, of course, to nickel's use in battery, it needs to be remembered that the primary use of nickel is an alloy in steel manufacturing and other forms of metallurgy. And the urbanization of emerging markets, populations, will also generate growth for the nickel. We need to remember, Patrick, that the natural resource bull market that we enjoyed in the period 2000 to 2010 was largely a function of the urbanization of 500 million people in China. That process continues, albeit not as much in China, although China does have, they estimate, 100 million more people to urbanize. But it's taking place in Indonesia, it's taking place in India, it's taking place in Malawi, it's taking place in Brazil. There's 1 billion people on Earth, Patrick, with no access to primary electricity, as an example. Over the next 20 or 25 years, we deal with that. And all of the benefits of urbanization and electrification will flow through to 1 billion extraordinarily poor people. And I think that we'll see a boom in the material standard of living of humankind. And that will include, importantly, nickel. These people will want refrigerators, they'll want washing machines, they'll want automobiles, they'll want all kinds of things that are made with specialty steels, as an example. They will want to use electricity on a distributed fashion, which is to say batteries. All that is about nickel. All that is about copper. All that is about rare earths. All that is about industrial materials.
Obviously, copper is gonna be there. So yes, I mean that's one metal that I think we're never going to get away from. It's always going to have a use. So copper is something not to forget as well. Platinum. Is platinum a commodity that is giving you any interest? I mean, if so, what would the upside for platinum be?
I own some platinum just because on a global basis, the cost to produce platinum is higher than the selling price, which is to say the industry is in liquidation. Platinum is produced really 3 places, South Africa and Russia primarily, to a lesser degree in Zimbabwe. So there are political risks around platinum. If you had real ongoing political disruption or social disruption in any of those places, platinum supply would fall precipitously, but platinum demand wouldn't fall at all. One of the reasons why the platinum futures price has been so soft is because the big thinkers in the world have suggested that we've seen the end or the beginning of the end of the internal combustion engine. Platinum, of course, is used as an auto catalyst to reduce smog from automobiles, among other uses. I believe that the internal combustion engine reaches its hiatus in 2060 or 2065, not 2030. So I believe that auto catalyst demand for platinum continues for at least 35 or 40 years. The consequence of that is that I think that the platinum prices recover at least to the point that the industry covers its cost of capital. But if you had broad spread social disruption in either Russia or South Africa, I'm not saying that you will, but if you did, I think you'd see the platinum price rebound very, very, very quickly. I will point out to you, too, that one of the reasons I think that platinum has been so soft in the last 3 years is that one of the big producers, Russia, has had a real incentive to sell it because they need the money. We saw this in 1990 or 1991, the last time Russia ran out of money. They cleaned out the cupboards of everything that they had that had a bid, including platinum and nickel. My suspicion is, and I don't know this to be true, my suspicion is that Russia's needs for money in the last 3 years have been such that they probably have not been making sustaining capital investments at places like Norilsk, the biggest single source of platinum and nickel in the world. If that's true, that will reduce structurally their ability to produce platinum and nickel for as much as 5 years after the eventual cessation of hostilities in the Ukraine.
People often ask, that they're looking at the gold price, which is about 3 times more than the platinum price right now. And, they do ask if I went into platinum, the upside of that, being that it was once higher priced than gold, there's a 3-time uptick to it. So I was just wondering, is that one way to look at it as well?
I think in addition to observing history, you have to look at the causes of history. I think that the importance of platinum as a monetary metal is less than it once was. It is important in certain cultures as a store of value. Korea, Japan, to a lesser extent among the overseas Chinese community. I suspect that for a while, at least, the predominant monetary metal in the world will be gold. But platinum still enjoys investment demand. It still is regarded in certain cultures as a store of value. It is preferred as a jewelry metal in Korea and Japan, and sometimes among various elements of the Chinese society. And it has these industrial utilities that gold doesn't have. The truth is that you can't make and sell a catalytic converter, an internal combustion engine in today's political climate without controlling the auto emissions. Less well known is the fact that these catalysts also work in industrial applications. So as an example, a big refinery in the stack where it's cleaning out the emissions from the refining process has platinum. And those uses aren't going to go away. And those uses are unique to platinum and palladium. They aren't shared with other materials.
Well, silver, of course, silver. I mean, still an interesting commodity to take a look at, considering it's fairly far from its all-time highs. Supply does seem to be a challenge, according to some sources, and demand looks to be increasingly growing. Yet, question we always hear, is why aren't we seeing silver run the same way gold has, considering how industry is chewing through silver?
Let me begin by saying, Patrick, in direct answer to your question, I don't know. My experience, and I've been in metals markets now as an investor for 50 years, my experience is that when the momentum in precious metals returns and the generalist investors become attracted to the precious metals narrative, that leadership in the market changes from gold to silver. Precious metals markets are unique in that they're driven by both primary investment motivations, which is to say greed and fear. But fear predominates at the beginning of a precious metals bull market, which is why gold leads. We're seeing exactly that. We're seeing gold lead, and we're just beginning to see the gold narrative attract generalist investors. Once generalist investors come down into the precious metals space, perhaps because the lower unit value, lower unit price of silver, silver begins to predominate. I don't know when that's going to occur. I don't even know why it's going to occur. But I do know that I have lived through three periods in my life where generalist investors have come into the precious metals narrative. And when that happens, leadership changes to silver. And by the way, Patrick, you won't need to ask RIckRule. You'll see it in the market. When silver runs, it's a truly spectacular circumstance. Uh, I've several times in my life watched really epic runs in silver in the decade of the 1970s from a buck and a half to 50. And by the way, that 50 is very different than today's 50. That happened in 1980. Remember what price levels were in 1980 until today. That number, if you were using real dollars, constant dollars, would be much, much, much higher. But then in the decade of the 70s, the silver price ran from something like $4 to 50 again. Crazy move, 12-fold move. And then in the decade 2000 to 2010, the silver price moved from $5 or $6 again to some number approaching 50, admittedly 50 nominal. My own suspicion is that the precious metals bull market that we're in now will be more profound than the bull market that we were in either the early 90s or in the decade 2000 to 2010. If I'm right, the consequence of that is that the move in silver, if it occurs, will be at least as dramatic as the markets that we've seen before, albeit from a higher base. You'll recall that the earlier runs took place in the context of a real price collapse. $50 back to $5, a 90% decrease in the nominal price of silver. We haven't seen that hard a pullback. We've seen a pullback from 50 down to, say, 20, now back up to 33. But I think when leadership, and I'm tempted to say when, I should say if, but I'm tempted to say when, leadership changes from gold to silver, the potential for dramatic moves in silver is much higher. It's important, again, to remember that when we talk about $50 being the nominal high for silver, we aren't talking about 2024 dollars. If we were talking about 2024, $2025, that number would be much, much, much higher. And it wouldn't surprise me to see silver take out its real, not nominal, highs.
And that would be because of money printing, inflation, all these different things.
Partially that, partially simply because when the generalist investor moves into precious metals, the space is so small that it can't accommodate the money. Patrick, you remember in earlier interviews, I pointed out that in the US market, the only one I really understand, the market share of precious metals and precious metals related securities is tiny. It represents less than 0.5%. Perhaps it does represent 0.5% of total savings and investment assets in the United States. The 4-decade mean is 2% market share. If demand for gold and silver merely reverted to the 4-decade mean, demand for the stuff grows fourfold. Understanding that prices aren't set across the whole transaction chain, but rather the delta between the supply and demand. If you quadruple demand for an asset class that is as small as precious metals, the price moves that you can get are truly astonishing. It doesn't happen often. It's happened 3 times in my life, but when it does, the results are mind-boggling.
Yeah, I mean, just hearing you say 2%, I mean, that sounds absolutely within reach that it'll happen.
Well, it's the 4-decade mean. We aren't talking about some sort of ephemeral concept. What we're talking about is what has been the reality over 4 decades.
Got to ask about the miners as well, since we're down this path with commodities. In general, uh, we do know there are variables, but which, in your view, may be a pretty decent buy? The miners themselves, or the metals when it comes to precious metals?
They're different styles of investment.
Yes, yes.
It's very difficult for me, Patrick, to understand why people don't own bullion. I really can't think of any investor, except for perhaps an extremely old person who's about to die. But any person who's interested in maintaining the purchasing power of their family for the future, I think needs to own bullion. So let's get that out of the way. You buy it and you store it and you hope it doesn't go up in price. The set of circumstances that causes it to go up in price can be very detrimental to the rest of your portfolio and to the rest of your lifestyle. And my lifestyle is very nice, Patrick. I'd prefer to see it not change, but I think it will. So you own bullion to maintain your purchasing power. You invest in high quality mining stocks, including high quality gold stocks. They've been on a tear the last 12 months. I mean, a true tear from very oversold levels. And they've been on a tear because just now their margins are beginning to increase. In past markets, the market has been led by the highest quality producers who ran after the bullion ran. That's what we've seen in 2024. If past is prologue, what happens next is that the second tier majors and the single asset producers, perceived by the market as riskier, move. If they don't go up in price, what happens is they get taken over by the large ones who have moved. Remember, this is a capital intensive business. And if your share prices are higher, your cost of capital is lower, you have a competitive advantage. We saw very recently, as an example, the takeover of Sentiment, a very, very, very high quality single asset producer, by Anglo. And this will continue. Either the second tier will move up or the first tier will take over the second tier. When that happens, investors will look for the next source of relative value and come down into the juniors. We're seeing the bull market unfold precisely the way the last three bull markets have unfolded. And I think it continues. I think the gold price, at least in nominal terms, goes probably not merely higher, probably much higher. Maybe it doesn't happen for a year, maybe it doesn't happen for 2 years, but it happens. And I see as that happening, the margins of the gold mining industry increase. They've been increasing dramatically for the last 2 quarters, and investor perceptions around them increase. So I think in addition to the fact that they'll earn more, their earnings will be priced at higher multiples. As I say, I'm saying this because I watched the process occur in the 70s. I watched it happen in the period 1989 to 1996 or 1997. I watched it happen again in the period 2000 to 2008 at least, but perhaps 2000 to 2011. I think in the circumstance past is prologue, Patrick. I think it's going to happen again. I think the reasons for it are changing a little bit, and my suspicion is that the performance of gold and the gold mining stocks relative to the rest of the market, which is to say the beta generated by gold investments, will be higher this time than it was in 2000 or that it was in the period 1989 to 1996.
Okay, hey Rick, I appreciate you've been giving us some great insights as far as these commodities go. So I appreciate you giving us your insight here. Um, Tariffs. I'll stick with Canada and the U.S. here since you have familiarity with both countries. What are your thoughts on the tariffs, which sometimes seem like almost like threats between these two countries?
Yeah, I mean, somebody needs to tell our president that tariffs are taxes. Colloquially, from my point of view, taxes suck. The idea that foreign producers will somehow eat this tariff when the tariffs are higher than their margins is silly. The U.S. consumer will pay the tariffs. And political elites in foreign countries, including Canada, will respond. It's trade, it's specialization that makes the world richer. Most people in the world are parochial, so they don't care about the world getting richer. They want advantage that accrues to them, irrespective of who pays the costs. One of the great things that occurred in the world in the period 1980 to 2020, 2022 was the positive impact of globalization, the increase in world trade, the increase in specialization and utility. And sadly, we're going backwards now. We're going to a period of economic nationalization, of transactional politics, and tariffs reflect that. Tariffs are taxes. Taxes are bad. Tariffs restrict consumer choice, which is bad. Tariffs restrict global specialization, which is bad. And tariffs increase competition and ill will between societies, which is bad. All of these are bad. We're going to survive them. We are going to survive them. The truth is that I believe, at least, that politicians, Mr. Trump included, are malevolent actors to be endured. An American society is bigger and longer lasting than our president. The relationship between the United States is bigger and longer lasting than the terrible T's, Trump and Trudeau. And we will survive that, and sanity will return over time. We will have to pay the price for our stupidity in the near term. That's true too.
Treasury yields. I took a quick glance at them and I see a 1 month Treasury at 4.37 or roughly around there. In general, the 1 month, the 2 month, 3 month, 4 month, and 6 month treasuries are offering a better rate than the so called benchmark 2 year and 10 year treasuries. Is this anything significant that it's telling us?
It's telling us two things. It's telling us that the Treasury itself is trying to drive down short-term yields, and it's not working. The market's responding. It's also telling us that the market expects a recession. There's less demand on the long end of the yield curve, which is very interesting. A scarier point, I think, I'm not trying to say that the specter of recession isn't scary, because it is. Given the debt loads, public and private around the world, reduced economic activity, and the reduced ability to service those debts is very, very, very scary. But something else is scary too, from a saver's perspective, at least as far as I'm concerned. If you look at anything from the 1 month to the 10 year, if you look at yields in the fours, if you compare that to the CPI stated rate of inflation, which is 2.6, the yields are not unattractive. You're getting a real yield compared to the deterioration of the purchasing power of the dollar. The problem with that is that I don't think that the CPI reflects at all the deterioration of the purchasing power of the US dollar. I look at the basket of goods and services that I consume going back to, say, 2020. Healthcare costs, just experienced that. Mortgage, gasoline prices, food prices, pick anything. The idea that the basket of goods and services that I consume has only increased at 2.6% per annum, or conversely, that the value of my savings has only declined by 2.6% per annum is silly. The other thing is, of course, that the CPI doesn't measure tax. The largest item on most household budgets in the United States is tax. And the stated measure of inflation doesn't include the largest single expense of households. If you believe, like I do, that the deterioration of the purchasing power of the US dollar is closer to 7.5% than it is to 2.5%, the idea that you're getting paid 4.2 or 4.3 or 4.5% interest in a currency where your purchasing power is declining by 7.5% is pretty scary. It means that if you buy the US 10-year, you're losing 3% a year in purchasing power, and you're doing that for 10 straight years. That is bad for savers, and conversely, likely good for gold. It's important to remember history, Patrick. If you take the circumstance that we survived in the decade of the 1970s, it was eerily similar to today. The specter of inflation and persistently high inflation. We called it stagflation then, a stagnant economy in the face of rising prices. In the decade of the 1970s, according to the Office of Management and Budget, the purchasing power of the US dollar declined by 75% over 10 years, which means that $1,000 in 1980 bought $250 worth of goods and services in 1970 terms. Not coincidentally, during that period, the price of gold ran from $35 an ounce to $850 an ounce. I'm not suggesting for a second that we're going to have a 30-fold increase in the price of gold. But I am suggesting to you that we are, over the course of a decade, likely to have a 70 or 75% decline in the real purchasing power of nominal US dollars. And if that occurs, it is likely, I believe, that the gold price trades materially higher.
Last question here. The Fed and interest rates, are they, in your view, do you think they are leaning more towards maximum employment or price stability, these two being both their mandates?
I think that the Fed is looking to avoid a catastrophe. I'm in the process of starting a bank, and I am in some contact with at least lower level Fed employees. By the way, are extremely high quality people. My criticism of politicians is mostly at the top as opposed to at the middle or at the bottom, where I find people to be very high quality people. And I would suggest that the Fed believes that the executive and legislative branches in the United States have absolutely no self-discipline, that they will spend us into oblivion. And I think that the prejudice of the Fed would be for higher interest rates to defend the dollar. But at the top, those are very political beasts. And so there is a political ethos in US politics that suggests that we need lower interest rates, negative real interest rates. And I think that there's conflict within the Fed, between the Fed itself thinking that you have to defend the dollar, and the political forces that govern the Fed say, no, you have to prevent a bond market collapse and a stock market collapse. And you do that with artificially low interest rates. Remember that fondness for the strength of the dollar is very ephemeral. But people's response to share prices and bond markets and their ability to consume, that is, access to their credit cards, is not ephemeral at all. You could look at the interest rate as a barometer of the relative importance of spending and saving. Low interest rates subsidize spending and investing at the expense of savers. Spenders are more numerous than savers. So in a democracy, unfortunately, I suspect, there will always be a prejudice in favor of low or even artificially low interest rates. For savers, this is not a good thing. If you are making 4.2% in a now account, in a currency that's declining at 7.5%, what you're really doing is reducing your purchasing power by 3% compounded. Now, if you're an old, fat, clever, bald, rich guy, RIckRule, artificially low interest rates are very good for you. If you have access to cheap credit and the knowledge as to how to apply it, it doesn't get better for somebody like me than a circumstance like today, which is one of the reasons why there's such an enormous disparity in outcomes in places like the United States. People who work hard, trust the system, put their money in the bank, lose money. People who understand, have access to credit, and understand how to use credit, benefit on the delta between return on capital employed and their cost of capital, which in my case has been an extraordinary benefit for 30 years.
Rick, Rule, I want to thank you for your time and insights. But before we go, I definitely would like to ask if you could let the people know how they can follow you and, of course, about Battle Bank.
Yeah, I have a few things I'd like to talk about at the end, if I may. The first thing is, if you like what I have to say about natural resources and precious metals, you can personalize it. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks, all of them. And I'll rank them 1 to 10. Please don't list companies you don't own. Don't give me a laundry list of 100 things you're looking at. But the portfolio of stocks you own, I'll happily rank 1 to 10. No charge, no obligation. Secondly, if you're in the United States or Canada 2 years from now and the rest of the world, and you're unhappy with your current bank, I suspect that's every person listening to this broadcast, check out Battle Bank, an organization coming soon to a computer or a phone near you. In particular, if you're a bullion holder and you'd like access to credit, if you'd like a margin account on your physical gold or silver bullion, check out Battle Bank. If you'd like to be paid interest on your savings, including your checking account, check out Battle Bank. Finally, and Patrick, I hope someday I see you here, the world's finest natural resources investment conference is put on by myself. It's been going on for 30 years. It's called the RIckRule, Natural Resources Investment Symposium. It takes place July 7th through 11th at Boca Raton, Florida, or via live stream from the comfort and convenience of your own home. Last year, over 1,000 people worldwide from 35 countries attended our conference via live stream. Whether or not you attend live or live stream, the conference comes with a 100% gold-plated money-back guarantee. If you don't believe that I've delivered enough value to cover your cost of admission, I'll give you your money back. How do we do this? Well, that's pretty simple. We have great big picture thinkers telling you the way the world is, not the way that CBC or CNBC tells you it is, but the way it really is. This year, including David Stockman, who ran the Office of Management and Budget during the Reagan years and was a ringside witness to the derailment of the Reagan Revolution for smaller government by politics. He'll be talking about the Department of Government Efficiency and whether or not Trump and Musk can in fact reduce the size of the U.S. government and hence U.S. debt. Probably the most important economic question that the world faces in the next 3 years. This is a guy from the belly of the beast. He was around the last time it was tried, but we go beyond that. Daniela DiMartino Booth will talk about the Fed because she was part of the Fed, again, from the belly of the beast. Nomi Prinz will talk about the structure of Wall Street. She was a partner at Goldman Sachs. Jim Rickards will talk about fiscal stability. He was general counsel for long-term capital management, the investor that almost brought down Wall Street. We're going to give you important big picture paradigms. And after that, we're going to introduce you to very high quality analysts, the John Hathaways, the Adrian Days of the world, people who have been investing in natural resources for 4 decades. So we'll tell you how the world works, and then we'll tell you how to use the way the world works to increase your own portfolio. Then we're going to give you a panel of living legends, entrepreneurs who have built multi-billion-dollar natural resource companies from scratch, telling you how they did it and telling you how the process made them better investors. And we're going to make them tell you what they're invested in today and why. Brand new panel this year, investing legends, people who have managed billions of dollars in natural resource investments. Again, telling you about investors' mistakes and how to avoid them. Finally, at our conference, every single exhibitor has been vetted. If they're public companies, they're owned in accounts managed by the conference sponsors. Now, that doesn't mean, sadly, Patrick, that every stock I buy goes up. But at every other conference in the world, the qualification to be an exhibitor is a check that cashes to buy a booth. At our conference, we have to have vetted them well enough that we've invested our time and treasure in them. And finally, as I say, unlike any other investment conference that I'm aware of in the world, this one comes with a 100% guarantee. The financial risk is all mine. Whether or not you attend live or live stream, we're going to give you 50 hours of extraordinarily high impact content within 4 days, more than you can possibly absorb. So you'll have access to the recordings of the conference for a full year. And I would suggest to you that I'm going to take 150 hours of your life. You're going to spend 50 hours at the conference, either live or live stream. And then you're going to need another 50 hours on the tapes to learn more thoroughly what you've learned. And then likely over the course of a year, another 50 hours to refresh your memory as to how to allocate your own capital in the times that we face ahead of us. Rule Investment Symposium, July 7 through 11, Boca Raton, Florida. Very simply, the finest investment conference in the world, guaranteed, or your money back.
Yeah, Rick, I'm hearing it. I'm feeling it. I just want to ask you one last question. Why would a person not want to go ahead and join you in this?
The only reason I can think of is if they're tourists. If you like the idea of natural resources and precious metals, but you're not willing to invest your time and attention, then don't come. We're going to give you a very, very detailed, very, very dense, very, very complete overview of natural resource investing. If you are the kind of person whose investment thesis has got a hunch, bet a bunch, don't come. You're going to be unhappy. If you want to understand what's really happening in the world, and if you want to defend your family's purchasing power over the next decade, not merely break even, but get ahead, and you're willing to do the work necessary to prepare yourself to make the decisions that will defend your family for the next 10 years, absolutely positively come. But if you're a tourist, if you're somebody who buys the newspaper to look at the funnies and the crossword puzzles, don't come.
Rick, you gave some, fantastic information, and I do appreciate that, and I really do hope we can do this again soon.
Well, thank you for the opportunity, Patrick. I enjoy the process. I've enjoyed it over the years. So at any time that you think my insights are useful, call me up. We'll do it again.
That was RIckRule sharing his views on the economy and precious metals. To see more of Rick's views and work, please do visit ruleinvestmentmedia.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.